This is FRM Part 2, Book 2, Credit Risk Measurement and Management, and the chapter on the evolution of stress testing counterparty exposures. A few key words in that chapter there, evolution and stress testing and counterparty exposures. We're in a series of chapters about, essentially default risk and credit risk and counterparty risk. We need to add stress testing to that. And the term evolution, kind of brings to my mind going back 10 or 20,000 years, where some dude woke up and said, I have thumbs, let me build a fire. And it took him 1,000,000 years to get to that point. Well, of course, evolution of stress testing, it's not taking millions of years for us to get to this point. Maybe decades. So maybe a better title would be adaptation or super evolution. But the beginning of the chapter is fairly interesting. It does give a little bit of a history lesson on the advances made in statistical measurements, but it also makes us aware that stress testing has not evolved or adapted very much. So this chapter it's almost a prescriptive or a suggestive chapter on how financial institutions can be better prepared for worst case scenarios. Now, this chapter was published back in 2013 or so, which means the bulk of it was probably written, within a year or so of the financial crisis that ended somewhere around 2008 or 2009. And so what we need to do is make sure that we're aware of the current state of stress testing, let's say in 2009, and then what we can do today in order to better prepare financial institutions for experiencing the far left tail of the distribution of either returns or values. So with that brief introduction, let's look at these learning objectives. The good news for you is that there are some things in here that we've just talked about in previous chapters. So we'll look at, different types of exposures. We'll differentiate among those, which you probably already know. We'll take a look at counterparty credit risk, which we have also been talking about. But what's emphasized in this chapter is the difference between credit risk and market risk, and the implications of viewing those either in isolation or ignoring one or the other. We'll go ahead and describe some stress tests, and then we'll calculate some stressed expected losses. And I have a couple of interesting examples that I think will add tremendous value to your understanding of this topic. And then I think that last slide will look at some common pitfalls. All right, so let's look at a brief history of counterparty credit risk management. And the chapter begins with kind of a discussion on long-term capital management. Let me give you my little history lesson on LTCM. This was founded somewhere around 1994 by a guy named John Merriweather, who was an extremely talented Wall Street guy who was well respected. He started a hedge fund, and the minimum initial investment was $10 million. Lots and lots of individuals were interested in this because not only was Merriweather, a well-respected guy, but he also enlisted the help of some of his friends like Myron Scholes and Robert Merton, who were Nobel Prize winners in economics. Now, what this $10 million got you was part ownership in this hedge fund, of course. But the interesting thing about this 1994 hedge fund universe is that the investors were not aware of what types of investments that the fund was going to make. Now, of course, investors knew that there were going to be some kind of derivatives, and what long-term capital management kind of focused on were these convergence trades, whether it was index volatility or mortgage-backed securities, or even emerging markets. And so I'm guessing you know what convergence trades are, but let me go ahead and just give you just a quick example. Suppose we're considering bonds issued by two, generally similar companies like Procter & Gamble and Johnson & Johnson. And so these bonds, they probably have high correlations, so they're trading like this. One goes up, the other one goes up. Well, sometimes for some reasons they separate. And so the idea is that you can take position up here and position down here, because sooner or later those prices or returns or some variable is going to converge. And of course, long-term capital management was successful in its first couple of years. I mean, even in consideration that it charged a 25 or 27% management fee, it generated returns of 40 or 45% in excess of that for those first couple of years. So everyone was high-fiving each other and was, of course, excessively happy. Then there was the Russian currency crisis back in 1998. And so those convergences, they were going like this, and the models that long-term capital was employing suggested, oh yeah, convergence like this, but they went like this. So there were these massive losses. And as you guys know about hedge funds, there's always that period where, you can't get access to your money. So imagine if you were one of these investors and you became aware of these massive losses, but you were unable to access your capital. So talk about a liquidity crisis. Now, of course, there were all sorts of bailout controversies back then, but essentially what happened was that Merrill Lynch and Bear Stearns came in and took over ownership and liquidated it. So the point of this, using this example in the beginning of this chapter, is that in all of these convergence trades, and of course there were lots of other derivatives as well, is that the counterparties were looking at this firm like, this was this giant financial institution that had no chance of failing. Look at that middle circle point I have in there. Counterparties viewed long-term capital as a safe entity with an insignificant chance of failure. And of course, when the investors are unaware of the actual day-to-day operations, whether it was, extensive use of repos or, investing in Russian currency or Russian bonds, and of course, using tremendous amounts of leverage that's available in the derivatives market, especially the swap market, this was a recipe for disaster sooner or later. And so this example sets us up for not only the awareness of counterparty credit risk, but how to manage it, and not to look across the table and think, oh, that entity or that individual is pretty safe. Maybe I should just consider them to be risk-free. I mean, that's a tremendous danger zone. Remember what do I teach you guys? I don't say this in every video, but most of them. Identify the risks. Identify the risks. Don't ignore those risks. Now, I've also talked about the stability of credit spreads, over the years, and this was really there was a dramatic increase in that financial crisis of 2008. And so these financial institutions, because they had these positions, whether it was, like long-term capital with these convergence trades or any other kind of a derivative, that all of a sudden the stability in credit spreads, went from something like this to something, like that. And of course, over on the balance sheet, this must necessarily result in lots of losses and, of course, some gains. Now, of course, regulators, remember we had the Basel, and we had the 1 and the 2 and the 3 and the 10 and the 20. We have all these regulators and governing bodies, come in and tell financial institutions, all right, look, we're learning our lessons. You guys are learning your lessons. And so let's go ahead and make sure that we do these credit value adjustments so that we're aware of the market value of this counterparty credit risk. All right, so what about these credit risk exposure measures? Let me go ahead and just quickly remind you of what we learned in a previous chapter. I think that one learning outcome asks us to differentiate between and among these different types of exposures. All right, so current exposure is exactly what you think it might be. Current exposure often is called replacement cost. So it's either zero or the market value of the transactions. So we have, all of these potential transactions. And so, we can draw a bell-shaped curve. Peak exposure then is going to be, maybe the 95th percentile, maybe 98th percentile, probably not 100 percentile, but what we're doing is giving this some high percentile of the distribution of those particular exposures. And then of course we're going to do this at dates in the future, maybe a week or a month or 6 months, whatever it is. And then the expected exposure is going to be taking the distribution of all of those exposures and then taking the average. And of course, I think I've shown you this graph at least 2, if not 3 times. Time on the horizontal axis, expected exposure on the vertical axis, and there's that hump. Remember I told you, and I think it was in the last video, about that peak is somewhere around 1/3 between the inception and the maturity date of the contract. And so those stars are time periods in the future, so we can take that weighted average to get that expected positive exposure. And this is very helpful when we're trying to figure out minimum capital requirements, right? I mean, if we think that we're going to have, this is the worst thing that can happen, then we don't need this much capital. However, if this is the worst thing that can happen, then this amount of capital is not going to be sufficient. Now, here's where I think the chapter gets a little bit interesting in differentiating between credit risk and market risk. And I'm going to go back to what we talked about many, many chapters ago, where we were considering financial institutions as a strategy, as a risk management strategy, these different silos. And if these different silos are separate and have a cap on them, then they can't communicate between and among each other. And so I want you to think of these as 2 silos. There's a credit risk silo, and then there's a market risk silo. And to illustrate this, let me go ahead and give you just a personal example between you and me. I've always given you this example with my financial calculator. Those of you who watch my videos will know that. Let's throw that one out. Let's do a different one here. Let's suppose you and I agree to exchange the royalties, the dollar royalties, on floating versus floating of the Beatles CD catalog versus the Rolling Stones CD catalog. So let's suppose I'm a big Beatles fan, so I want to receive the Beatles and I'm going to pay you the Rolling Stones. So as long as the Beatles sell more, then I'm going to be receiving more than I'm going to pay you. Well, the credit risk, on both sides is that you and I, we do other things. And so we can be successful operationally over there, or we can fail over there. And so the credit risk is that when it's time for you to make your payment to me, that you're going to be unable to do that. Market risk, on the other hand, in our specific example, has everything to do with the music industry. What happens if there's some kind of a technological advance that for some reason makes the Rolling Stones catalog more valuable than the Beatles catalog? Well, that's market risk, right? And so I'm going to be paying out more. And so this is going to affect counterparty credit risk. And so we've got to take the caps off of those 2 silos so that those 2 silos can communicate, and we have that big umbrella over the top, right? So what the chapter tells us is that both of these views on counterparty credit risk are valid and reasonable and acceptable ways to manage the portfolio. But when you adopt one and ignore the other, then you're ignoring this. So that's why I have the but in the middle there. Every choice has its own implications. So we need to manage credit risk and we need to manage market risk. course, one of the big risks that I'm facing in that little derivative is that isn't Mick Jagger, isn't he 100 years old? He's still out there rocking and rolling like he used to. He had a heart attack or he had some valve replacement. So look at that, man, that's really going to affect, those cash flows between you and me. Remember, Mick Jagger's heart attack really has nothing to do with my ability and willingness to pay you or yours to mine, unless it impacts those cash flows dramatically. All right, enough of that. All right, so here's kind of a summary of what I've been talking about here. Credit risk view versus the market risk view. In this credit risk view silo, we're going to establish those potential future exposure limits and then manage those by the terms of the contract. Of course, when you and I get together, I'm going to say something like, why don't you put up an initial margin? Why don't you put up some collateral? Why don't we make certain that we have these netting agreements? Why don't? So we have all this stuff here. But if we ignore the credit value adjustment in the determination of the present value of all those cash flows, then you or I are probably going to have some kind of a balance sheet surprise. On the other hand, if we have this market risk view and we're focusing just on the music industry and we're worried about the quality of Mick Jagger's voice, we're worried about Mick Jagger's health. Of course, there are only two Beatles that are still alive as of 2020, so we're worried about, Paul McCartney and Ringo Starr, and we're worried about these kind of things. If we ignore the simple fact that you or I have all of these other operations going on, then a sudden default on your part or my part, boy, that could result in massive losses as well. Now, back over to the credit risk view silo. The way we're going to manage this risk is through these collateral arrangements and then the replacements of these trades. Because if I believe that you are nearing default or are in financial distress, then I'm going to probably offset that trade with another derivative with somebody else. So that now I'm managing that credit risk by doing some offsetting and using those risk mitigants. But I'm still exposed to market risk, right? Now, if Mick Jagger's health falls, and remember now, I'm paying the Rolling Stone royalties, and so let's just assume if something happens to Mick Jagger, and sooner or later he is going to pass away, so that might make my cash outflows much higher because people will rush to buy those Rolling Stones CDs or their songs. Well, what I'm going to do is probably try to hedge somehow with other institutions out there or other individuals so that I can say, okay, if Mick Jagger does pass away, then I'm going to replace that with somebody else. Little Richard? Well, Little Richard just passed away, or somebody else, right? All right, so here's kind of a summary on the implications for stress testing. And remember, the theme of this chapter is, right, we've really advanced in our statistical measures. Now we need to catch up with stress testing. So as a credit risk implication here, these exposures are going to include current exposure, that peak exposure, and the expected exposure. As a market risk view, we're going to, of course, compute that credit value adjustment, and then we're going to measure the standard deviation or the variability in that credit value adjustment. And maybe we'll use standard deviation, and maybe we'll use that standard deviation as part of value at risk. Nevertheless, the conclusion is that you have this silo, and then you have this silo over here, and so each silo is doing its own unique stress testing, and then we have to link those two stress tests. And so what we're going to do is we're going to have lots and lots of stress testing. And of course, how I teach my students this, especially in the capital budgeting / increasing their exposure and skill set in Excel and spreadsheet technology is I have a big matrix there where we're trying to compute net present value of a particular project. And so we have revenues and expenses and depreciation and taxes and all that stuff going down the left-hand column. And then we stress it. Now, of course, when we do this sensitivity analysis in capital budgeting, we change each individual variable, but we increase it or decrease it by certain amounts. But here with stress testing, not only are we just decreasing it, we are massively decreasing it. So you think of this spreadsheet where you go from, a positive number here, and then, you lower it and lower it until you get to that stress level. Now look at that first block point. Stress testing is an adequate way to measure risks and assess whether an institution has these internal controls that are both adequate and reasonable and informative. Think of a big old Excel spreadsheet. All right, so what happens? We're going to stress current exposure, and we're going to change a variable, and then we're going to reprice that portfolio. And we're going to stress it by some kind of a market exogenous variable. Of course, for financial institutions and these derivative arrangements, especially swap contracts, that stress is probably going to be some kind of a change in interest rates, whether it's a spike in interest rates or whether a dramatic decline in interest rates. But the example that I have in this slide is, let's suppose, there's some big market decline, 10% over the relative short term. How is that going to impact counterparty credit risk? So this is the way that financial institutions will stress test current exposure. All right, so let's suppose that we simulate some kind of a market crash. We have this table. So we've got these 5 counterparties, so A, B, C, D, and E. So 5 different financial institutions. Notice that 4 of them have investment grade ratings. One of them is below investment grade, that double B rated counterparty. Notice the mark to market is all positive. So our exposure is all positive. And notice we go from a real small amount, 2, all the way up to a maximum of 200. And then we have collateral with some, and we have no collateral with others. So our current exposure for those first 2 counterparties with no collateral, the current exposure equals the mark to market. So there's the 2 and the 50. And then for C and E, the collateral equals the change in the value. So we've got 0 current exposure. And then in counterparty D, we do have some current exposure because the collateral is less than the MTM. So think of this Excel spreadsheet where we're going to stress the current exposure. We're going to say something like, suppose the equity market declines by some big amount, right? What happens to current exposure? And so those numbers over there on the far right column are just hypothetical amounts that are the result of stress testing on an Excel spreadsheet. So notice the bottom block point, how much each counterparty would owe the bank under that specified scenario. And then we rank them according to their stressed current exposure. Now this is interesting. You might think that looking at just the second column there, that our non-investment grade bond, which has a positive mark to market and 0 collateral, right? So that's the most risky of all of the counterparties. You might think that would be the riskiest under this stressed current exposure model, but it turns out to be just, not to be, right? So we rank them 1, 2, 3, 4, 5. And of course, this is just the result of one hit to this Excel spreadsheet. What we'll probably do is take multiple hits to that spreadsheet and then maybe take an average. Now let's take a look at a loan portfolio here to compute something that we've called expected loss in the past. What we're going to do is just sum up the individual exposures of each of those loans. And so there's a formula that should be familiar to you. So expected loss on the left-hand side of the equal sign, there's the big summation. So we're going to be adding however many loans we have in the portfolio. And notice I have these input variables in different colors. So probability of default in red, that's going to be a %. And then the exposure at default and the loss given default, those could either be percentages or dollar amounts. One has to be $1 and one has to be a %. We'll see that in a table here in just a second. So there's our traditional expected loss equation. And then what we're going to do, think of this Excel spreadsheet, we're going to go back and say, well, you know what? Our probability of default for a loan that we made to a particular business has a 2% chance of default. But let's suppose that we look at the macro environment and we say something like, look, what happens if, and I'll make up some variables, unemployment spikes, or oil prices spike, or inflation falls to zero, or. You could come up with lots and lots of these macroeconomic reasons, or you could come up with some microeconomic reasons that relate to that specific loan. Suppose that individual loan was made to a bakery, and the price of sugar, bakers use sugar? I think they do. The price of sugar either goes way up or way down. Here, let's suppose it goes way up. And so the probability of default, if the price of sugar, spikes by 100%, let's say, then this baker is going to have to charge lots of money for its donuts or its cakes, and maybe its demand will fall and maybe it'll declare bankruptcy. All right, so what we're going to do is we're going to take the exposure at default and the loss given default as deterministic, and we're going to allow the probability of default to fluctuate stochastically, let's say, and we're going to change that. So maybe it goes from 2% to 6%. And so the stress loss is really just going to be the difference between those two equations. Let me show you how simple this is. So let's suppose that we have a probability of default of 2%. We have a 40% exposure and a loss of $100 million. So we use that formula that was at the top of the previous slide, and we get, what is that, 800,000. So let's suppose that we increase our stress probability from 2 to 2.4%. And remember, that change from 2 to 2.4% is going to depend on those underlying variables, the shock, so to speak, to the system, whether it's microeconomic or macroeconomic, and what is the likelihood of that particular loan defaulting under those conditions. So it's important to remember that you're not going to just say, 2% and then 2.4%. I mean, you're going to put, some tremendous thought and rigor into coming up with that stress probability of default. So go ahead and recompute the expected loss and then just take the difference between the two. And that gets you up to $0.16 million of a stress loss. And of course, look at the bottom block point. All we're going to do is we're going to just sum the stress losses. This was our first loan, right? So we have another loan and we have a third loan, et cetera, et cetera. Now the question then becomes, all right, Jim, that was pretty simple for, a regular old fixed income security like a loan, but the focus, of course, is in the derivatives market, going back to the Rolling Stones and the Beatles and going back to long-term capital. Of course, how do we apply this to a derivatives portfolio? Well, the good news for you guys is that we're going to use that same equation, but we're going to substitute. Here, let me go back here. What did we use back here? We had that exposure at default as the purple variable. And now we're going to have the expected positive exposure. Remember, we want to get rid of all those negative exposures. We only are concerned about when the counterparty owes us we're positive in the MTM, right? So the one change between this expected loss for the derivative portfolio versus the loan portfolio is the substitution of that particular variable, right? And we're going to add an alpha factor to this. And the alpha factor, even though it is alpha, you can interpret it as a sensitivity. It's actually the ratio of the value of our derivatives portfolio over the value of some benchmark portfolio, which could be our derivatives portfolio weighted in a different scheme so that it reflects kind of averages. So that alpha is just really some kind of an adjustment, and it's going to turn out to be like 1.2 or 1.3. And so it's going to capture the extra risk of our derivatives portfolio as it relates to, general risk throughout the market. If alpha is a ratio that captures that extra risk, you're probably thinking along the same lines that I am, that, all right, if we hold the entire market portfolio, if our derivatives includes everything, including my swap with the royalties for Beatles and the Rolling Stones with you, then we have the entire market portfolio, so that alpha has got to be 1. All right, so that should make perfect sense then. What did I say earlier? That the alphas are, maybe 1.1 all the way up to 1.3 or so. And if you look at some of these published studies out there, alphas are somewhere, 1.1, 1.2, somewhere in that range. I actually looked at the Wild article, and it was interesting because it includes a measure for wrong way risk in there. Remember we talked about wrong way risk that includes measures of correlation between and among, all of those different types of exposures out there. Another interesting row is the regulatory prescribed value of 1.1. So what the regulators want is for financial institutions to be conservative, to make sure that they capture that entire amount, so that if the exposure is this amount and with an alpha of, let's say, 1.1 or 1.15, we're somewhere here instead of being out here. And so that one, it's not surprising that it's 1.4. Look at the bottom one. Possible values for concentrated portfolios 2.5 or more. So the derivative, if I am specializing in rock and roll derivatives, and I have Beatles and Rolling Stones with you, and I have Fleetwood Mac and Little Richard with somebody else, and I have Elton John and Billy Joel with someone else, boy, these are concentrated portfolios, and it makes sense then that the exposure is going to be greater for my portfolio than everybody else who's trading in regular old derivatives out there. All right. So let's go ahead and look at an example that is virtually identical to what we did with the loan portfolio with the 2 changes. All right, so there's our alpha 1.4, very small probability of default. There's our loss given default, 70%. 220 million. And so if we do the math just quickly, we get, 0.11 million for the expected loss. Makes perfect sense, right? So now let's go ahead and increase the probability of default from the 0.05% to the 0.5%. Let's raise it by a factor of 10, which is more dramatic than we did in that earlier example. And so what we need to do then is figure out what that expected loss is under these stressed conditions. And then our stressed expected positive exposure is going to be greater than the expected positive exposure in the non-stressed, right? So we go from 220 all the way up to 350. And so we get 172. So now, boy, you see how, what do we know about loans? What do we know about derivatives? Derivatives are leveraged, right? So that change in the inputs from our first equation to our second equation is much more dramatic. So there's our stress loss of 1.61. You see how this example really captures the notion of derivatives trading as it relates to all these factors that we have been talking about so far in this chapter. Now, one of the cool things about this example is that it gives you ammunition to attack that one learning objective where it says to calculate the stress loss. Now, how about stress testing CVA? So we've got all of these counterparties. So notice what we're going to do here. This credit value adjustment on the left-hand side of the equal sign. On the right-hand side, we're going to sum those loss given defaults, and we're going to multiply that by the sum of the expected exposures times some probability. Now, what we're doing here with this credit value adjustment is that we've got to be very sensitive to what kind of probabilities we're using. Now, of course, we need to consider these marginal default probabilities, and they have to be risk neutral. Now, remember, the concept of risk neutral simply means that, we have a price. We can see a price of a portfolio, and we know what its cash flows are. If it's a bond, we know what those are supposed to be if it's a fixed rate bond. But if it's a derivative portfolio, we know what we expect those to be. And so we can force the present value of those future cash flows to be equal to the price. And then we can solve for those variables like a marginal default probability. So a risk neutral marginal default probability and a risk neutral loss given default. In addition to the discounted expected exposure, these are just variables that we're solving for that force present values to be equal to prices. And then, of course, to get the stressed credit value adjustment, we're going to change some of those inputs. So we're going to change that to a stressed risk neutral discounted expected exposure and a stressed risk neutral marginal default probability. And the difference between those two, and let me just go back here, the difference between that CVA and that CVA that is stressed is going to be that stress loss. Now, the chapter doesn't come up with an example, but let's go ahead and whoops, I went one too far ahead. Let's go ahead and come up with an example here. We've got a 1-year CDS, recovery rate 40%, spread of 200 basis points. There's our expected exposure. We need a risk-free rate. So what is the credit value adjustment? Now, what we're going to have to do is use some of the inputs and some of the equations that we learned in previous chapters. So let's go ahead and come up with that hazard rate. You remember we denoted that as lambda back in the old days. So that's an easy calculation, right? That's 0.0333 with a bunch of threes there. We can use that to come up with our estimate for the marginal default probability. We did that several chapters ago, so that gives us 3.22%. And then we can just use our formula. So there's 1 minus the 40%. Remember, we're doing this for one derivative times the 30 million times, that's essentially a present value. So we get the 551, right? So there's our credit value adjustment. Now, the second part of this, what happens, look at question 2 there in the middle. What if we were to shock the expected exposure and the probability of default? So once again, think of this gigantic Excel spreadsheet, even though we don't need it. We don't need it when we're just doing one individual component of our portfolio. But think of that giant Excel spreadsheet. All right, so what are we doing? We're shocking them. We're increasing them both by 50%. And so you go, just do the math there, and you get 1.2 million or so minus the 551 from the previous page, and you get 689 as our stress loss in this derivative, one trading of the derivative. And so what we can do is we can repeat this if we want to do this over multiple periods and multiple counterparties. Now here's a slide on the debit value adjustment or the debt value adjustment, depending on which one of those terms you're more comfortable with. But just like in our previous chapters, the DVA formula is virtually identical to the CVA one. But let's go ahead and look at some of the interesting changes here. So look over in column 1. Of course, with DVA, we're not going to use expected exposure. We're going to use negative expected exposure. And then over in the second column, we need to make certain that when we're doing the bilateral component that we consider both, let's just go back to our Beatles Rolling Stone. We need to consider both your likelihood of default and my likelihood of default, and which counterparty survives first. And so there's that bilateral CVA formula. And this is the stressed one there, right? So there's, we're going to take the first one and then we're going to subtract the second one. And notice, the big difference is on the left-hand side, we have the expected exposure. And after the minus sign, we have the net, the negative expected exposure, right? So look at the two important observations. Survival probabilities depend on CDS spreads, and the losses depend on the firm's own credit spread. And look at that. For instance, a loss may occur because of an improvement in the firm's own credit quality. Of course, that sounds fairly interesting and counterintuitive. But we also cannot forget correlation. So we must consider from a bilateral perspective how our own credit spread, my credit spread, is related or correlated with your credit spread. So look at the last block point. Stress losses can be calculated for both the DVA or the BCVA, just like we did in that previous slide. And here's a summary slide on the very final learning objective. All right, so what are the following pitfalls? And this is a problem. This is a problem all the time. So let's just go ahead and read that. Relatively new practice, right? Institutions tend to segregate CCR stress test results. So, there's the silo, here's the silo, here's the silo. Remember, we need to open up those silos so that the silos can tip out, or at least that they can talk to each other. Now, the temptation, of course, is to go back to that one table that we had when I showed you that current exposure for a loan portfolio. The temptation is just to look at current exposure, but we need to consider that humped illustration, expected exposure and expected positive exposure. So of course, current exposure gets us started, but what we need to do is evolve. Can I go back to the title of the chapter? We need to evolve to include these other measures of exposure. And when we have this big old Excel spreadsheet, so we're changing some of those inputs and then recomputing values or returns, however we want to do it, and then we're going to hedge. And we know from our very first days of risk management that we're going to use some kind of delta hedging, right? However we want to calculate or define delta, but what do we know? That delta, that's not a straight line, right? It's not like you can draw a line when something is convex and then hope it works. It's non-linear. So just like we have to make a convexity adjustment to changes in fixed income portfolios, because duration is just a first derivative, we need to do a second derivative. And so we need to make those kinds of awareness adjustments in this model too. So look at my last sentence there. Although models have been developed to attempt to achieve linearization of delta sensitivities, they often lead to significant errors. Okay, we know that. And that takes us through this chapter. This was a fun chapter for me. I hope it was for you. Of course, the reason that I went through that a few minutes at the beginning of this slide deck was to focus on the evolution part. So there are probably some, reasonable questions to say, okay, this is where we were in 1980. This is where we are currently. How has this evolved? So an awareness, so differentiate and explain and describe. An awareness of that history will help you answer those kinds of questions. And then hopefully with the several examples that I showed you in this slide deck, you'll be able to do those calculations.